Hello, my friends. This is Craig Larson with Larson Financial Advisors and the Market Minute for January 22nd, 2013. We've had a couple people ask us about high inflation or even hyperinflation, and can that come to the United States? So what is hyperinflation? That's an extreme loss of the value of a currency, such as what happened in Zimbabwe in the 1990s or Weimar Germany in the 1930s. For those of you that haven't studied history, I'll show you an example of this. My friend John Thomas, the Mad Hedge Fund trader, gave me this at lunch one day. It's a $50 trillion bill. Now that sounds like a lot of money. Unfortunately, this is Zimbabwe dollars. So 50 trillion won't even really buy you a sandwich anymore. So it looks really pretty, but it's essentially worthless. And the same thing happened in Germany, and there's a few other historical examples as well. So could that happen here? We've had some people, read Bob Wiedemer's book Aftershock, or maybe look at Doug Casey's writings or so forth. Now, I met Bob Wiedemer at a conference one time, and I got to pick his brain a little bit. He's certainly a very smart man, and maybe his predictions will come true, although it certainly doesn't look like it right now. And why is that? There's two ingredients that are needed for hyperinflation. Number one is present in the United States, and that's significant money creation. Right now, the Federal Reserve Bank is creating out of thin air about $85 billion a month, almost $1 trillion a year. And they do that so that there's somebody there to buy treasury bonds. So the government can spend significantly more than it makes. In fact, the federal government right now in the United States, out of every dollar it spends, about 43 cents of that is borrowed money. It's really poor financial management. So we do have that money creation element present. But there's one thing that's missing, and that's velocity of money. That money that's created needs to get in the economy and start changing hands quickly to create inflation. And we don't have that. So how do we calculate that? I went to the St. Louis Fed website and I got a chart on the velocity of money. That's, by the way, attached to your email if you're a list subscriber, and it's available to the public, so you can go and look at these things too. And hopefully you can see it, either check your email or look here, that the velocity of money right now is essentially below a previous low. It's basically at a 60-year record low. So this money that's been created is just not getting into the economy and swirling around at all. So for now, we could say that there's really not a significant risk of high inflation or hyperinflation. Now that could potentially change down the road in the future. We'll definitely keep an eye on this for you, but right now, rest assured, everything's fine and we don't have that problem yet. When we see shifts in trends, we'll let you know on a future update. In the meantime, have a great week and thanks for tuning in.